Okay, welcome to the launch of the 2021 Lunchtime Learn and Network series. My name is Tammy Klein, and I am the president of the Mayfield Area Chamber of Commerce and your co-host today, along with Frank P. Nagorney and Greg Costabile of Buckley King. Today's event focuses on Paycheck Protection Round 2. We will start our event with introductions. I encourage you to leave your business contact information in the chat. This event will be recorded and available on the Chamber's website, www.mayfieldareachamber.org. So let's get started with the introductions. Frank, you want to start?
Sure. And I always enjoy doing programs like this. It's a little different than my day-to-day routine. I am a partner at the law firm called Buckley King, and I have been working with entrepreneurs and private business owners on their tax matters and succession planning matters. And a program like this, I look at it as access to capital for them. And it's great to join your presentation today. Thank you for the invitation.
We're happy to have you. Greg?
Greg Costabile, also partner at Buckley King and vice president of the Mayfield Area Chamber of Commerce. And, also this is what we are trying to do through the chambers, try to, in a creative way, bring information to our membership, provide them opportunities to not only understand more of what all the members do, but hopefully, as a collaborative group, we can find ways to help one another. At the law firm, my experience is primarily in litigation, both business and consumer, family law, mediation, and municipal law related work. So I thank my partner, Frank, for being here and giving his presentation. I'm sure it'll be helpful to all listening.
John?
I'm John Marquardt, Economic Development Manager for Mayfield Village, and also a board member of the Mayfield Area Chamber. Glad to be here this morning and look forward to the presentation, Frank. Thank you.
Bruce?
Hey, everybody. Everybody knows me except for Frank, but Frank, to meet you and looking forward to this presentation. I'm Bruce Beckold, CPA. Have a little firm out in on the east side called Sweetbriar, and I'm also the treasurer and board member of the chamber. So while I'm pretty well versed in PPP, you can always learn something new, and glad to be part of it.
Michael?
Can you guys hear me real quick?
A little bit more.
Yep. I'm Michael Lamarca from Master Pizza here, Cleveland, Ohio. Board member of the chamber as well, and looking forward to seeing what we could all pick up some information today and hopefully pass it along to our friends in the business.
Yes. Okay, Frank, you can get started with your presentation.
Yeah, well, let me share my screen. Let's make sure everybody can see it here. And it should be this one. So can everybody see it? Are we on?
Yes.
Online? It's great stuff. Great stuff. I'm one of those people. I'm not an early adapter on electronic communication. So if it's working for me, that means it's come a long way. Well, I have been doing a couple of presentations on the Paycheck Protection Program over the months since round one was implemented last year, and Greg invited me to pull together some of the additional pieces that came up last December when this act was passed to share with the group. And it's always a good reason to be able to pull together and do some research and get myself current on what's going on in this space. And so we're going to spend about 15 or 20 minutes going over some of the new parts of the program. Well, hang on, let's see. Now I got to be able to move my slide.
On the bottom,
Boy, that took a while. Yeah. Did you do that or did I do that, Tammy?
I didn't, you
Oh,
did.
okay. Well, I'm not. Okay. Anyway, so our agenda today, we're going to go over some of the new eligibility rules. I've actually struggled with, but successfully completed some applications for round two. And then we'll talk about loan forgiveness and some tax implications of this program. So let's go to the next slide here. Okay. There's some changes in the specifics of the program, and it's interesting hearing about we have a franchisee here on the program. I hadn't really anticipated that, but there's some specific things that are pretty good for what his business is going to be. But eligibility this time, the Congress wanted to focus on a little bit smaller companies, no more than 300 employees. In round one, the limit was 500 employees, in some cases even more so. And for those who are in the accommodations and food services business, and I think that would be our guest for Master Pizza here, that its limit is 300 employees per location, as opposed to 300 employees all across the nation for all the franchisees. And so, and there's also some special features that enhance what someone in that space can do. And then certain nonprofit corporations have been added to the list. So to the extent any of our audience is from a 501c3 or certain 501c6 entities, they ought to be looking at whether they can take advantage of this program and help get themselves some access to capital. So the main feature of the eligibility rules that are coming up under round two is this analysis of what's called gross receipts. And in order to be eligible for this program, a company has to have experienced a decline of 25% or more in gross receipts from 2019 to 2020. It can be done on a calendar year basis. It can be done on a quarter to quarter basis. It can be, but there has to be a 25% reduction found in one of those periods of time. And so what we're finding is that it's the first and second quarter of 2020 when most companies had the decline in business that they hit. It's not always the case, but certainly when businesses were shut down on the retail level and certain kinds of manufacturing operations, that's where the hit is. And in order to determine whether you've incurred that, you actually have to take into account all the relationships that you might have with affiliated companies. And these rules are kind of complicated. The simple part of that rule is, are you under common control? And we'll talk about that in a few minutes. But primarily, you have to have a 25% decline on a quarter or annual basis. The company needed to be in operation on February 15th, 2020, and not permanently closed at the time of the application right now. And in particular, round one funds have to be expended before you can go ahead and get a disbursement for round two. A lot of clients tell me that they haven't spent their round one money yet. And I'll tell them, I says, well, maybe you have your round one money sitting in a bank account somewhere and you haven't touched that little pot of money. But if you have spent money on payroll, if you spent money on utilities and mortgage payments, you have dispersed the money. It may not have been out of the pocket that you set aside, but you have spent the money and you ought to be eligible for round 2 disbursement. Very importantly, unlike round 1, which had a long period of time in which a company could apply for round 1 money. In fact, it's continuing right now. The deadline for applications now is at the end of March. So if you haven't already applied for your round 2 loan, there's about 6 weeks left to get it done. And after that, it's the end of this program unless it's extended by Congress. All right. So how much can we, hang on. Okay. So how much can we get? These are the loan terms that we're looking at. It's the same, very much like it was under round 1. You have to look at your average monthly payroll costs. And here you can use 2020 as well as 2019 as your base for calculating average monthly payroll costs. Or you can use the 1-year period immediately before the loan is made. So if your loan is going to be made on March 1, you could actually use the 12-month period going back from February 28th of this year back to March 1st of last year. Whichever one gives you the higher dollar amount. There are a lot of questions about seasonal businesses in round 1 and what made something a seasonal business. Those rules generally have gotten clarified, and what's permitted is if you are shut down for part of the year and you operate for a certain number of months. Generally speaking, your average annual payroll is based upon the months during which you're operating. Very interestingly, I had a client who had 2 seasonal businesses. One was a landscaper and one was a snowplow business. And it turned out that they weren't a seasonal business after all under these rules. And so the way we calculated the payroll was based upon what they did throughout the whole year. But if you are in that business, it's worthwhile running the calculations because if you can do it on a seasonal basis, you can get more money on the loan. If you're newly incorporated during 2020, there's also a series of rules that lets you just use the period in which you're operating your business as the measure period for determining payroll. The methodology is the same for both businesses. You take 2.5 times your average monthly payroll. For those that are in this NAICS code of 72, which is basically a hotel and food and beverage services, you can multiply by 3.5 times. And that is a benefit. The limit is $2 million, and no public companies are allowed to borrow money under this program, like happened to a lot of news and publicity in round 1. A lot of people gave their money back when it turned out they really didn't need this kind of access to capital. And by the way, if anybody has any questions or chats, Greg's monitoring chats for me. I think Tammy is too. And or if you have any comments on specific provisions, just break in and let us know. It's a small group. Payroll costs has not changed since round 1. Generally speaking, salaries, wages, cash tips, vacation pay, healthcare benefits, pension contributions, 401k contributions, all those things that go into payroll costs count and go into that average monthly calculation. You multiply that times 2.5 and you get the amount of your loan. This cap on highly paid employees of $100,000 remains, and it's applicable not only to highly paid employees, but the the cap also applies to entrepreneurs, independent contractors, folks who run their own business and may be the only employee or the only person working for their business. And so there's numerous rules in the Internal Revenue Service, what they call their interim final rules on how you calculate this for those kinds of situations when you're touching the $100,000 cap per person. Okay. I mentioned affiliates a little earlier on. And what are affiliates? Because in round one, the only meaning that affiliates had was just the employee count. If a company had a number of plants or operations around the country, there was you had to count all the employees in order to determine whether you were going to have this 500 person employee or less eligibility requirement satisfied. In round two, not only are affiliates counted in determining whether you meet the 300 employee threshold, but it also counts in determining if you've realized a 25% decline in revenue. So it has an additional impact here that can be pretty impactful in running these calculations. So these are who we count as affiliates. Like I said earlier, owners who control more than 50% of the voting stock of a company are affiliates under common control. And in other cases, you just don't have individuals owning more than 50%. Maybe there's three partners, everybody owns a third. Or maybe there's someone who owns 49% and everybody else owns other pieces. And so they look to other kinds of management control. The rules reference board of directors and officers controlling management can be deemed affiliates. Even if you have minority partners like a venture capital partner or an investor in your company who has the power to veto certain kinds of company actions, is counted as an affiliate. A particular problem if your equity investor, so to speak, is a hedge fund or someone who has a lot of investments in a number of companies, and they have these kinds of veto rights. Even persons holding contract rights, such as buy-sell agreements or other types of contract rights in which to limit management's ability to run the company, can be considered affiliates. And so it's important to look at this rule in the context of the 25% reduction, as well as in the context of the employee count for the 300. Any questions about that? Affiliations? Anybody run across that rule at all? Good. Okay. So what can we use the money for? Now, this hasn't changed in any significant way. There's some add-ons under round two. But generally speaking, you can use the money for payroll and benefits. Ohio unemployment taxes are also included. It's not so clear that workers' compensation is covered in this item. Maybe Bruce has a thought on that. But I've always taken a conservative approach because that's an insurance program as opposed to a tax program.
Yeah, you're definitely correct. But again, I have yet to find anybody applying for any kind of forgiveness where something like that's becoming an issue. Usually they have more than enough
Yeah,
rent expense. So
yeah, because you can use up that 2.5 times pretty quick. And these are the other items on my bullet points here: rent, interest on mortgage payments, not the principal, just the interest, utilities. And then they added these last three categories here. If the business had been damaged, in any of the riots that occurred or any of those civil disturbances. That can be a covered cost. Um, Essential supplies are something that that are considered. If you purchase new software, if you have perishable goods, you have certain critical items that you order before what we call the covered period, those can get covered. And they also added a category for covered worker protection costs. So, it's one thing to buy masks for your employees and one of these temperature devices that you press up against your forehead. But if in fact your business had to spend money in order to protect your workers or to set up in order to engage in business, that also can be a covered expense. So,
Frank, we had a follow-up question under the when you were talking with the affiliates, and in your example of the landscape and snowplow business, was there affiliation the reason that each of those businesses were not considered seasonal?
Yes, because you have to take into account the gross receipts of not only the borrower, but also all of its affiliates in determining whether the 25% reduction had occurred. They were seasonal businesses, but because of the combo rule of adding in affiliates for purposes of the gross receipts test, they just didn't make the 25% reduction. It turned out that it was the snowplow business that actually had a quarter where there was a reduction of 25% because of all the shutdowns in February, March, April of 2020. But the other activity during the other months of the year just combined to make that company ineligible for any of the advances. I hope that answers the question. Not something you would normally think of in that kind of context, but there is a gotcha in that rule. Okay, so over this last weekend, I actually had to put together an application for one of my clients. I said, Frank, I don't know how to get through the bank. Can you help me out on it? So I got all of the data and I said, all right, I'll give it a shot. So here's what I did. And here's what the process is. And it's a little bit different than round one, but if you did round one through one particular bank, the recommendation is to do round two through the same bank because a lot of the data is already there. It's already compiled. But if you were not happy with the bank that did your loan in round one, you are absolutely allowed to go ahead and use a different bank for round two and get the job done. What I found in doing this application is, the SBA rules talk about this form 2483 SD. But that form didn't appear on the website. What appeared was a series of questions from the lender where your responses would then populate the form itself. And at the end of the application process, you'd see the form, you can review it and make sure that it's filled out right. But I found the way the bank did it actually was pretty easy to follow. The recommendation from the banks is that you compile all the documents required for the transaction ahead of time. Scan them into your local drive, have them ready to download into the application when asked. Otherwise, the program will just time out on you, ultimately, if you have to go back and get it done. It allows you to save your work and then come back to it. But, I think if you're going to go do this, you want to run through the whole thing. And I spent a couple hours on this, is what it took for me to get this done. You got to compile your payroll data. They want to know what your payroll data was so that they can calculate the 2.5 times or the 3.5 times in determining the amount of your loan. And in order to do that, they want your payroll information. So the information can come from the company that processes your payroll reports on a regular basis. They also asked for copies of state unemployment reports. The SBA had its own payroll worksheet that's in the package, and you can file your 941s or your W-2s and 3s as well along with it. And I did all of them. I figured I'm going to put it all in there. I got it all ready to go. Let me put it all in there because I want to make sure that my loan amount is calculated properly. I don't want to have to come back and have to go through the process again and maybe lose my place in line. So I think it's important to compile all the data. The verification of gross receipts is its own little corner of that application. Verification can come in different ways. It can come from your bank statements. It can come from income tax returns. It can come from your financial statements. And the income tax returns is a little tougher unless you've already filed your 2020 income tax returns, because they would compare year to year, 2019 to 2020, to see if on an annual basis there was a 25% reduction in gross receipts. If you want to do it on a quarter by quarter basis, your tax returns just don't quite get you there. And so the SBA allows for you to provide financial statements that are prepared on a quarterly basis that are verified by the company officers. You can use bank statements, which is what I did. I took the monthly bank statements for my client. I crossed off the bank account number that was on the forms. And then on the deposits, I noted whether it was revenue from a customer or if it was a capital infusion from the owner of the company, because we had both. And they do ask you to annotate on any of the documents that you provide exactly what the source of the deposit is, so that the lender and the SBA can calculate whether or not you've met this 25% reduction requirement. The application does say that if you're going to have a small loan under $150,000, you do not have to provide this verification of gross receipts at the front end. You can provide it when you're asking for loan forgiveness. My advice on that point is, I just want to know up front that I'm going to qualify for this. I don't want to find out at the end of the day when I'm expecting to have, $100,000 of debt forgiven, but guess what? I didn't make it. I only had a 23% reduction in my gross proceeds because of the manner in which it gets calculated. So even for the small loans, even though you don't have to, my advice would be to really, do the verification up front, make sure your loan amount is right, and then go forward. Second point here, the application also asks for information about the owners of the business and any affiliations that you have. And so we had that circumstance here. In fact, there were 3 affiliated companies controlled by the same individual. A couple of them were startups, not doing very much business, but they do ask that you provide a paragraph that describes those affiliations. And if you have affiliations and don't, report it, because you don't think it's important enough to do that. I think you can get in trouble on your application, because there's a lot of tax return information that people file that does report that. And so it's not that difficult for the SBA or the IRS to figure that out. Now, here's where I ran into, I am not that familiar with technology problems. On the application form, there's a whole bunch of boxes that you have to check. And going down the left-hand side of the application form, on the one I was looking at, there are all these big X's on these boxes. And I thought, well, all right, there, we got them pre-checked for me. Well, after about 20 minutes of trying to figure this out, I just clicked on one of those boxes and it changed the X into a check mark. And I had my solution, so I was able to go run the answers. I don't know if anybody else got stuck on that, but it happens to people like me. It is worthwhile.
Definitely, it's very quirky looking. You think it's all handled, but you do have to click it.
Sounds like you've done a couple of them, Bruce.
Just a couple.
Okay. All right. So, and you do want to review your application for correctness. I found that I missed a decimal point on my loan amount, the most basic piece of information, and I was getting 10 times less money than I wanted. So the review process makes some sense. And then at the end of the day, at the end of the form, there's an electronic signature for submission. And so if the software, when you click on that and you sign electronically, if it accepts it and it takes it, guess what? You filled out all the boxes that they're asking for. If it doesn't take it, you got to go back and figure out what it is that you missed and then complete it. And save your work all the time too, because you don't want to have to go back and do it again. I wound up getting a confirming number from the SBA that lets me track my loan at the bank. And now we're waiting to see what happens. Mike or John, did either of you guys submit one of these applications, or are you looking at doing it? What's going on with you?
I have not. My role is basically to sort of pass along as much information as I can to my constituents and my local companies. So I've not done this personally. I'm just trying to provide as detailed a story as I can.
Yeah. Mike, have you done it yet?
The first one.
Are you going to be eligible for the
second.
second one, or are you going to be eligible, or has business been okay that you don't have that big reduction?
Oh, there's a reduction, but it's I have added some stores, so I got to look into that.
Yeah.
So it's just figuring that out.
Yeah. If you have purchased some stores from others as opposed to just opening up stores, there's some special rules that apply when you buy or sell pieces of businesses that would touch you and that you want to take a look at, something like that. Okay, so the most important thing in this whole process is loan forgiveness, right? Under round number one, what they call the covered period was either 8 weeks or 24 weeks. There was no in between. And when the program came out, the 8 weeks was really a problem for people who were shut down because they were not able to make the payroll percentage that was needed over that 8-week period of time in order to get the debt forgiveness. Ultimately, that threshold got lowered down to 60% of the money, and you could elect to have a 24-week covered period. And that allowed more time in order to spend the money on payroll and other kinds of expenses. It was a huge relief for those of us who monitor these programs. And under the current program, the threshold also is 60% of the loan amount must be used for payroll costs. The covered period is not just one or the other. It can be from 8 weeks to 24 weeks. So if it turns out that you spend the payroll money over in 12 or 18 weeks, in 2 or 3 months, nothing to prevent you from electing that shorter period of time and going in and applying for your loan forgiveness. There's also nothing, you can certainly also wait out the full 24-week period of time, in which event most companies really satisfy the use of funds on their payroll and don't have to look further at some of their other costs.
Frank, a question on the forgiveness, and maybe this ties in a little bit with the eligibility. You said earlier, that the people that went through round one had to pay everything down before they applied for round two. However, if they still had the money that they received in round one in a bank account, but they can show that they actually really have spent down, they just didn't use it from that account, that could still make them eligible for two. So my question to follow up with that is, even in round two here, if you use the money that you receive in the loan for the payroll or how you're supposed to pay, however, the business's profitability would have allowed them to pay their payroll without the loan. Does that still allow for the forgiveness that you're referencing?
Yeah, yes, it is. In fact, the companies that maintain their payroll are the ones that, in a sense, the philosophy of the program is those are the ones who are entitled to the money. You maintained your payroll. We're gonna make this money available to you. There is an overriding principle that the companies have to certify that they need the money, that they need the money in order to have access to capital and stay in their business. In round one, there was a lot of discussion that companies that had lines of credit, that had other sources of funds, were still taking out this money, and they didn't need it for their operations. That is an analysis that's really a company by company look at that certification that you need to make. There is a certification on the application that says you need the money for the purposes that are being shown here. So if a company did not have any downturn and has plenty of capital and is making money, making a good amount of money, there is a question about whether that company is actually an eligible company. And I have to look at that, and you would have to look at that if you are applying for one of these loans, on whether you feel that you're qualified for it. The lender and the SBA are allowed to retroactively look at your operations and decide whether they think you needed the money in the first place. So maybe that's a little more information than you want, but it is a factor.
No, I guess I would take it the other way. Wonder if an applicant retroactively needed the money, but then the loan comes in, and thankfully for the business, they turned it around.
Yeah.
And they now became profitable to cover their expenses, yet they still had the money. Do they still have the opportunity for the loan forgiveness?
Yeah, I think so. I mean, if you can show that you needed the money when you're making the application, I think you're gonna be there. The philosophy of the legislation is they want you to be able to use this money to resume operations and start being profitable. So I think that if you're successful with the money, I don't think that's going to impact your debt forgiveness.
Okay.
It's actually a pretty modest threshold. They're looking for the abuses of the need rule here. Also on loan forgiveness, there's the regulations are talking about the fact that if you're borrowing less than $150,000, there'll be a simplified forgiveness application. We're all waiting to see that. But I think everybody needs to be prepared to show that they spent the money on appropriate. Just like in the beginning, when you're applying for your loan, you need to show what your payroll was. You need to show what your gross receipts were. Once you receive the proceeds, you're going to need to show and prove the payroll costs, the rent cost, the utility cost on which the money was spent. And that's a matter of bookkeeping and accounting to show that information. And that would get downloaded with your forgiveness application and processed through your bank. The bank has about 60 days to review your information and pass it on to the SBA. The SBA has 90 days to look at it and go from there. Most of my anecdotal information is that it hasn't taken that long. But that's with the folks I've been dealing with. We were really right on top of filing for the loan forgiveness as soon as we satisfied the requirements, got the information in, had everything scanned in, made sure it was right. And it got through the bank fairly quickly. And surprisingly, the SBA was pretty responsive. At least that was my experience. It's not everybody's experience, but maybe I just got lucky. Okay. There are some tax implications that have been talked about over these months of the program. Early on, the IRS was taking the position that there were two tax issues with respect to the money that you received. One is if your loan was forgiven under general tax principles, well, that's forgiveness of income and that's taxable. And or any expenses that you were spending would not be deductible as well. The Congress remedied that in this legislation. They made it clear that there's no income tax on loan forgiveness. It's actually treated as tax exempt income in the year it's forgiven. So it'll get reported on your tax return, I would anticipate, and then it would be claimed as tax exempt income so that it's not taxed in that year. Any expenses that the payroll cost, utility cost, rent cost, you can continue to deduct them just as you always have, whether or not they're essentially covered by your paycheck protection loan or coming out of your regular revenue of your company. So the tax results have turned out pretty good here. All right. There's a couple of other, we're getting towards the end here. There's a couple of other pieces of this legislation I just want to bring to your attention. The employee retention tax credit has been beefed up. It now runs through June. Actually, I think it's supposed to be June 30th. I'm sorry about that. So it's June 30th of this year. I anticipate that might get extended as well. And they've increased the coverages here. It used to be $10,000 per year per employee, and now it's $10,000 per quarter. There's some adjustments in the credit amounts and the revenue reduction that are part of this. And I just draw this to your attention that if you're in this situation, check it out with your accounting firm or your payroll provider so that they can run you through the details of this particular program. I think it's a great benefit if you can do it. The one caveat is that if you're reporting wages for a paycheck protection program over a 2.5 month period of time, you can't use those same wages for this tax credit. So, you got to look at your paycheck, your payroll, for example, from January to March 15th. And if you're looking at the employee retention credit, you'll be looking at it March 15th through the end of June. So you can't count the same wages twice. Okay. A couple of other features here. The economic injury disaster loans, which a lot of folks went out and got $10,000 advances under that program that wound up getting taken back on the Paycheck Protection Plan. They continue to be available. The legislation indicates that at this point in time, it should not be reducing the Paycheck Protection Program loans. I really haven't touched that, but I draw that to someone's attention that if you didn't apply for that $10,000 before, it might be worthwhile taking another look at it today. If you're looking at retrofitting any buildings or commercial properties, there's also an extension of the tax credit available for energy efficient commercial buildings. Actually, it's a deduction on the depreciation, and believe it or not, they're allowing us to deduct business meals all over again. So I guess it's time to go out and after this lecture, we can go out and buy lunch and for each other and maybe be able to deduct it. This is where all the SBA interim rules are. Last time I looked at them, there were 62 pages of them. And that's just for the second round. There is a lot more rules from the first round. I just put this out here. It's not too hard to find on the web, but if you have particular rules that you're concerned about, this is a source that I would go to and that you can as well too. All right, well, that's my formal presentation to everybody. If there's any particular questions about it or not, we're open to hear any inquiries. If anybody has anything.
Frank, I thought this was really helpful. Thank you. And I didn't realize with this second round that those funds could be used to help businesses that were damaged by the rioting and things like that. So definitely walked away with something I had never heard before.
Good. Listen, I would, maybe kind of as a wrap up for me here, I do a lot of strategic planning for my clients, at this stage. And I am always very interested in access to capital. And this is such an unusual program from the government here to allow clients not only to access capital, but also to allow it to be forgiven. And different companies have had different strategies on how to spend this money. Strategic planning is strengths, weaknesses, opportunities, and threats. And certainly this money presents an opportunity for all private businesses to try and figure out how can they best use this money to preserve their companies or to grow it. The recession has already happened, and so we have to recover from that. And what Congress is doing in these two programs, and what I expect we'll see in the next one coming up, are certainly programs that small businesses can benefit from. And I'll keep watching for everybody. Appreciate your time today.
Thank you, Frank.
Thank you.
Frank, can you stop sharing your screen?
Oh, now you want me to do, okay. Look at that, it works. Okay.
Fantastic. This was very vital information, and I think that it's going to be a great video for our membership to actually review. And since this, the loans are actually being taken until what was it, March
31st.
March 31st. So this is a great time to actually get this information out to our membership. And as it'll be included, a link for this will be included in our weekly newsletter. So a lot more people are going to be able to actually benefit from this really good information. And we appreciate that you actually presented today. And so glad that you were able to be with us. And Greg, thank you for bringing Frank on board for this presentation. It was very helpful. So I just want to close with this. We have our next series is actually our Lunchtime Learn and Network series. There's going to be another one on the 24th of February, and it's going to be about all our MACC benefits, which is really crucial because so many of our members don't really understand really what our benefits are. And so this is going to be with Cindy Holtzheimer of Northeast Ohio area Chambers of Commerce. And this is really going to be vital information for our members. So with that, anybody have any closing comments? Good. Okay, well, Frank, again, thank you so much. And everybody, thank you for being here. And we'll see you at the next Lunchtime Learn and Network. Thanks.
Thanks, Tammy.
Thank you.
You're welcome. Okay.